a company just making money, go to work every day. They weren't aggressive. They weren't trying to grow production. And these guys came in and said, wait a minute here, you guys. And so instead of being lazy, they're like the complete opposite. They're like, let's maximize profitability, which is what they're doing. So they have these two core assets, Nicaragua and Colombia, that they can upgrade, they can make more efficient, they can do exploration. So those projects alone are like 300,000 ounces long life. Then they have another property that they acquired in Chile that's 2.5 million ounces that they'll go after. And I don't think they're done yet. Colombia and Nicaragua are actually very good countries to go looking for additional properties. Then Chile's another one, Peru's another one. I don't think these guys are done yet. So, like I said earlier, they printed a 10-bagger at $7,000 gold. They're generating about $200 million in free cash flow at $4,000 gold. So, and their balance sheet's a thing of beauty. $240 million in cash. I have you at $35 million in debt, but that's going to go bye-bye very soon, or it's already gone bye-bye. I like those three names a lot. I own them. I think Exelon, the key to them, they need to figure out a way to grow their silver production at their new mine. If they can do that, it's going to do really well. And then Aftermath and Norsemont, really good spec bets. They have the goods. Norsemont, the only red flag for Norsemont to me is a little bit of concern about permits, but they're probably going to be fine there. Once that project gets permitted, I think it's going to absolutely blast off. And then Aftermath, we're waiting for, are they going to skip the PEA and go right to the PFS?
I'm not sure.
Yeah, we haven't
we
haven't had a PEA yet for them, so that's
correct.
Important. One thing I want to mention today is producers.
Sure.
So the HUI is down to 623. Now I'm an investor. I don't care about the near term. I'm always looking long term, 2 to 3 years out, and I always use higher gold prices. If I don't care about the next 12 months, then I certainly don't care about the gold price. So I'm looking out 2, 3, 4 years, and I'm using $7,000 gold. And right now, Wall Street is pretending that the price of gold is never going to go up again. The valuation of these companies has gotten to the point where it's getting ridiculous. We got Agnico down to like 144. It was trading at 250. It prints as a 4-bagger at $7,000 gold. So we have these majors. We got Agnico, Newmont, Barrick, Alamos, all printing as 4-baggers. So if the elite, and I call these stocks the elite 8, and I'm not a few others in there, Lundin Goldfields, Anglo Gold Ashanti, they're all 4-bagger plus the elite 8, which is kind of crazy.
When taking a long-term investment horizon of 2 to 4 years, valuation models often project far higher underlying commodity prices than current spot markets reflect. Evaluating large-cap miners like Agnico Eagle, Newmont, Barrick, and Alamos Gold against an aggressive target, such as $7,000 gold, reveals significant potential multi-bagger returns. Despite broader market indifference toward precious metals assets, Tier 1 majors retain strong underlying fundamental support. Central bank accumulation and broader macroeconomic pressures continue to build a structural case for gold, positioning large-cap miners as heavily discounted cash flow generators poised for eventual repricing.
Wall Street's ignoring these. So those aren't the stocks that I'm focusing on. I'm just giving those as a background. Now, if those high, the best of the best on the majors are all 4-baggers or better, you can imagine what the mid-tiers are. And I always said the mid-tiers are kind of the sweet spot. This is the opportunity right now to buy these mid-tiers at these levels. So I was going to mention some. In Canada, there's only 3. Now it's going to grow, but right now we have West Dome, which has been, they've been there for a long time. They're the one that's been around for a long time. And then you have Artemis Gold, which just went into production in 24. And now you have Hemlo, that's a new company that was acquired from Newmont. So you got 3, and then it's going to grow. But people are going to buy these stocks like candy once gold prices go up because of the location. The other stocks I want to mention is Australia. So those are your 3 tiers. Those are your 3 choices in Canada. Now we're going to look at Australia. Australia is very similar location dynamic as Canada. In other words, it's a place where investors are comfortable. They're like, okay, I have no problem buying these stocks, and I'll buy them in the U.S., Canada, and Australia. So let's look at Australia as well. So we got Westgold, Regis, Ramelius, Greatland Resources, and Capricorn. Those stocks, I mean, it's unbelievable that you can buy them at these levels. I've always known in the past that when you get into a strong sentiment situation, the Aussie stocks get pricey. I remember 2009, 10. Like, I want some of these Aussie stocks, and they're all trading at multiples over 20. You don't really want to buy stock that has a multiple over 20, and you want to buy them sub 15, sub 10.
Mid-tier producers operating in top-tier jurisdictions offer an appealing balance of risk and growth. In Canada, established players like Wesdome sit alongside growing producers such as Artemis Gold and new corporate consolidators reviving legacy assets like Hemlo. Australia presents a similar market dynamic, featuring robust mid-tiers like Westgold, Regis Resources, Ramelius, Greatland Resources, and Capricorn Metals. While historic bull markets drove Australian mining multiples past 20 times earnings, current valuations remain at compelling single-digit or low double-digit entry points. Highly safe jurisdictions remain primary targets for capital allocation as market sentiment shifts.
So this is your chance. So I just wanted to bring out, now those are I'm just focusing on quality mid-tiers, or some of those are, almost majors. They're basically emerging majors. They're big mid-tiers, all of those. There are other stocks around the world as well, mid-tier. We have Jaguar Mining, I think is really undervalued. You got SSR Mining. And then we have the company we have coming on today, Mineros SA. So that's the reason why I wanted to go with these producers, because they all fit into the bucket that Mineros fits in.
So to give Mineros a little bit of exposure here, I know one of the reasons we're having them on is because you thought they were a really good value. Where do they line up? I mean, where's their multiple? It's not 20, it's not 15. Where is it?
It was at 2 when Sun Valley just got involved. Sun Valley was like, what the heck's going on here? I mean, it was literally the cheapest mid-tier out there, trading at a 2 multiple. Now it's up to a 7. And the reason why it's up to a 7 is because this new management team came in and people started noticing it, and it's been ripping higher. But even though it's at a 7 multiple, I have it as a 10 bagger. So it's still uber cheap, but it was unbelievably cheap when Sun Valley got involved. And Sun Valley, complete turnaround story for Mineros, a new management team, new focus, and he'll talk about that.
Sure.
And it's absolutely an exciting story. It's starting to get out now. It was under the radar, trading at 2 multiple. At one point, it was traded at 2. Today I looked, it was a 7. But I love the upside. I love the growth story. So yeah, it definitely fits into this bucket of undervalued mid-tiers.
Excellent. Well, just to quantify for our listeners, when you're talking like 4 bagger or 10 bagger, you're using $7,000 gold as your metric, correct?
Thank you for bringing that up. Yes.
Yeah. Just because some people get a little.
Mineros SA serves as a prime example of a mid-tier value unlock driven by corporate activism. Historically viewed as a conservative dividend payer that underinvested in exploration, the company shifted dramatically after institutional backer Sun Valley acquired over 50% of outstanding shares. This shift ushered in a refreshed strategy focused on operational efficiency and resource expansion, operating long-life core assets in Colombia and Nicaragua alongside growth projects in Chile. Mineros expanded its valuation multiples while retaining immense cash flow potential, strong balance sheets, and substantial long-term reserve expansion capacity.
Excited when they hear these things.
I don't care about the current gold price. That's not how I invest. I could care less. I'm speculating. I'm speculating. I believe, we're not going into macro today, but I believe that the underlying fundamentals of gold have never been better. And that I actually think 7,000 is a conservative number. I always use conservative numbers. I think we're going to fly past 7,000. That's my gut feeling. I actually think the people that are going to buy gold don't even know it. The average person has got 50, 75% of their net wealth in the stock market and own no gold, the average investor. And those people are gonna, when they sell their stocks, they're like, get out. They're like, okay, now what do I do with my money? And like right now, they're not even thinking about gold. Most of the people that are going to go into these miners, they're not even thinking about it today. We're way ahead of the curve on this.
Yeah, we are. I want to point out to people, I've only said this a couple times, but when we met coming out of COVID in Las Vegas, you were talking $4,000 to $5,000 gold then, and very few people were outside of Rob McEwen and the usual suspects on Kitco. So, I mean, it's not far-fetched to think of these terms because the world is just a different place than it was in previous rallies, right? Like this is a weird one. This is where the S&P, the Nasdaq, the Russell, the Dow are all melting up. By the way, emerging markets as well. I took a look at the EEM, which is the big ETF for that. It's at a 20-year high, Don, almost. I mean, that's coming down. Like, I mean, that looks like a very attractive short to me. There's just way too much going on overseas.
Yeah, I just want to, I have to bring one little comment on macro here. It's not like we're saying something that's out of the ordinary. Paul Tudor Jones, I mean, this is the guy, I mean, Ray Dalio. These are guys that have been around forever. Warren Buffett, Jeremy Grantham, Jim Rogers, all these guys that have been around forever are all basically ringing the bell saying, people, look out, look out, look out. But Wall Street is like, oh, everything's fine, everything's fine.
Traditional wealth management strategies continue to heavily concentrate capital in general equities while largely ignoring precious metals allocations. Renowned macroeconomic observers and institutional investors have increasingly voiced caution regarding overextended equity markets and mounting sovereign debt burdens worldwide. As capital seeks alternative safe havens, precious metals stand out as under-owned hedges. The potential rotation of institutional and retail capital into precious metals equities could trigger rapid valuation expansions, particularly among low-cost mid-tier producers capable of generating massive free cash flows during prolonged commodity rallies.
I'm pretty sure I was a shareholder before Sun Valley got involved. I'm not positive. I have to go back and look, but I think so. But I remember when you guys got involved. So Sun Valley, they basically, they're investors, and they saw this company and they saw how the upside potential. They just said, this is ridiculous. We have to go in. And they went in heavy. They own over 50% of the shares, and they're not going to sell. And then one thing I asked them, I said, are you just going to flip this? You're going to basically double, triple your money and get out, And he said, no, we're in this for the long haul. So I've been excited, and then I've watched them execute for the last 2 years. It's been excellent. Like you said, I don't know if it's been a 10 bagger, but it's been up pretty big since they got involved. But the one thing about Mineros, they were somewhat of a lazy company in that they were not exploring aggressively. It was very minor annual. They weren't increasing the reserves. They weren't increasing the resources very much, very little. So they have these two properties that have been in production forever, long life mines, and they were just milking them. It was basically, a company just making money, go to work every day. They weren't aggressive. They weren't trying to grow production. And these guys came in and said, wait a minute here, you guys. And so instead of being lazy, they're like the complete opposite. They're like, let's maximize profitability, which is what they're doing. So they have these two core assets, Nicaragua and Colombia, that they can upgrade, they can make more efficient, they can do exploration. So those projects alone are like 300,000 ounces long life. Then they have another property that they acquired in Chile that's 2.5 million ounces that they'll go after. And I don't think they're done yet. Colombia and Nicaragua are actually very good countries to go looking for additional properties. Then Chile's another one, Peru's another one. I don't think these guys are done yet. So, like I said earlier, they print as a 10 bagger at $7,000 gold. They're generating about $200 million in free cash flow at $4,000 gold. So, and their balance sheet's a thing of beauty. $240 million in cash. I have you at $35 million in debt, but that's going to go bye-bye very soon, or it's already gone bye-bye.
Identifying standout mid-tier mining investments requires a systematic screening process focused on reducing downside risk while maximizing upside potential. Strategic investors prioritize companies with high-grade, long-life assets, low geopolitical risk, and proven operational management teams. Furthermore, a clear growth pipeline consisting of active exploration and project development is essential. Finally, tight share structures and high insider ownership, such as Mineros's rare institutional and management backing, align corporate goals directly with shareholder value, signaling a well-governed producer primed to deliver exceptional risk-adjusted returns over a long-term investment cycle.
I basically use an approach where I try to get an edge. So the way that I get an edge is I look for companies like yours. So the first thing you look for is you look for a company that has high-quality properties. Properties that are going to generate a lot of revenue and long-life mines that are going to leverage higher gold prices. So high good properties. Next thing's location. So you don't want to have too much. You don't want to have any location risk, which is impossible. But you don't want to have moderate. You don't want to have high location risk. So now they're in Colombia and Nicaragua. So some people would say, "Wait a minute, Don. Those are high-risk countries." But all countries can add risk. Location makes important. But Colombia now has a new president who's conservative. So the risk level in Colombia right now is actually very positive. And Nicaragua, we haven't seen any problems in Nicaragua. So I wouldn't call that as a high-risk country right now. So on the whole, I think that's good. Then you look for the management team. So these guys have been in business for 50 years. They know how to operate their mines. And so I always talk about companies that are trying to kind of grow into an elite mining team or trying to grow into an experienced mining team. These guys already are an experienced mining team. And so I don't see that as a red flag per se. Back to my getting an edge and why you guys are such a case study there. So the other thing you're looking for in a producer is you're looking for growth. You don't want them just to be stagnant or going down. And so you want long life mines, but you want growth. You guys have a really good pipeline. Both of your properties, both Nicaragua and Colombia, both of them have exploration potential, growth potential. Plus you have 2 development projects, La Pepa, and then the one Ptolemy you just mentioned. So pipeline's fantastic. So you look for companies that don't have a lot of red flags or no red flags. And then once you identify those companies, the next thing you do is you look for valuation, which is kind of the last step. And when I look at your company, so the one thing I want to do, so I'm a speculator, I don't really want to get too excited for a producer that's not at least a 5-bagger. So if it's a 3-bagger or a 4-bagger, those are kind of usually your majors. But right now, a lot of majors are 4-baggers. So I'm like, I'm not really excited those. So I'm basically 5 is kind of my minimum. And then I start getting excited once you get to about 8. It's hard to find a high quality producer that's a 10. Right now we can, which is kind of crazy. You're one of those. You're like at the top end, which is kind of crazy considering your stock has went from 56 Canadian to $6 Canadian. You're still cheap. But when you look at, you want to systematically approach, when you invest in these companies, you want to systematically look at all of the variables that go into what values a company. And then you try to identify, what are the red flags? And if you can't find any, then you go to the valuation, or you can't find anything that's significant, go to the valuation. And so for me, you guys do stand out in kind of a cost benefit analysis or a risk reward analysis. You guys do stand out. The other thing that I like about your company is your insiders. That's another one for me that's important. But a lot of times in producers, it's hard to find a company that's got 25% insiders. You guys are unique in this regard. If you go and you look at your peer group, which is basically a mid-tier producer with a market cap of 500 million to 2 billion, and try to find one that has 50% insiders, of those peers, there's probably 20 of them. There's probably one more. That's it.